What's up, everybody? Welcome to another episode of Hidden Forces with me, Demetri Kofinas. Today, we speak with Christopher Cole. Christopher is the founder of Artemis Capital and the portfolio manager of the Artemis Vega Fund, which seeks to profit from periods of volatility, dislocation, and systemic crisis in financial markets. His core focus is systemic quantitative and behavioral-based trading of volatility derivatives. Sounds complicated. It is. You are going to hear a lot of wild terminology during this interview. Everything from mean reversion to volatility persistence, spot vol versus implied vol, vol of vol, system CTA, system rebalancing strategies, enterprise EBITDA, case Schiller PE, price to book, price to sales, left tail, right tail. But don't worry, it's all noise. What you need to remember is that volatility is change. Volatility is uncertainty, and we live in uncertain times. Time to get used to it. This episode is about exposing you to ideas and ways of thinking and investing that fall far outside the mainstream. It's about looking at risk as opportunity and understanding that markets are inherently uncertain. As always, you can gain access to reading lists put together by me ahead of every episode by visiting the show's website at hiddenforcespod.com, where I will also have a special list of items referenced during the show for anyone interested in digging deeper. Lastly, if you are listening to this show on iTunes or Android, make sure to subscribe. If you like the show, write us a review. If you want a sneak peek into how the sausage is made, or for special storylines told through pictures and questions, like us on Facebook and follow us on Twitter and Instagram at Hidden Forces Pod. And now, time for this week's conversation. All right, so Chris, it's great having you in the studio, man.
Yeah, it's a pleasure to be here.
I was just saying right before we started recording that you had been on my show in 2012. You do remember that?
I do remember that.
Do you remember where we met?
I think it was at Jim Grant's conference.
It was. You were speaking at Grant's conference, and you were talking about volatility. And that was when you had just released that paper, Volatility at World's End, I think.
That's right? Yeah. Volatility at World's End in 2012, the first part of that year.
Yes. So had you done any papers like that beforehand? Like, had you done anything kind of colorful?
Yeah, I'd written some papers prior. I think that's I think in general there had been sort of a following, but I think Vol at World's End was sort of a unique paper in the sense that paper actually had an impact on moving the markets.
Really?
And I think, in retrospect, I think the main argument turned out to be quite correct, that the left tail was particularly overvalued and that the right tail was undervalued. Ironically, I kind of feel differently today. But I've since released, there was a paper I did in 2015 called Allegory of the Prisoner's Dilemma.
Right, we're going to talk about that.
Yeah, so I had been doing some papers up to that point.
All right, so you're, okay, many of our audience may not know you. One of the things I tell people is when I ran that show, when I ran Capital Account, there were always three types of guests, and I always made room for one of the three types who was always someone I didn't necessarily recognize, or it wasn't someone who did a lot of media, but whose stuff I thought was just brilliant. And I thought your stuff was brilliant. Your stuff still is brilliant. And in fact, if you guys want to, I'm going to post this on our website in the show notes. Anyone wants to hear a really dope house music track, you can hear Chris overlaid with market volatility from 1991 volatility through 2011.
Yeah, there was a visual animation.
Beautiful. I had the guys here. So we're in a music studio. We record this. This is actually, there are a lot of hip hop stars that come in here all the time. So I played it for all the guys here. They loved it. Did you have somebody make that for you specifically?
So that was a unique project because for a long time, I was in Costa Rica and I was watching the waves come on in from Costa Rica on the ocean. I thought, the ocean looks like volatility waves, but no one ever looks at market data that way. They don't see the kind of beauty of it in a visual sense. And I'm like, well, I could show that if I animated it. So I worked with a special type of animator out of Perth.
Australia.
From Perth, Australia. And it was a truly global project. And then collaborated with a then unknown DJ out of Paris named Mansour Adi. Now, Adi's gone on to go open up for Beyonce.
That was a long convexity play on your part.
That's right. Yeah. So I think everyone's done really well. Obviously Artemis has grown a lot since 2012. Mansour Adi's done very, very well. I think everyone associated with that project has gone on to to do sort of interesting things in their respective field. But it's really about taking some interesting music, taking some very real data, and then finding a way to visualize it in a way that I think people aren't used to looking at in a very artistic way. And so that video actually is a visual animation of the volatility term structure from 1990 to about 2012. And it looks like beautiful waves in the ocean, but all of that's actual, very real stock market data.
And terrifying if you're in the middle of a tsunami.
Yeah, that's right.
So let's do a recap. This is how I want to start, and I really want to give a strong context for our audience. And I think that really starts with taking a look at pre-2008. So pre-2008 was a period of great monetary expansion and fiscal expansion, not just in the United States but globally. And of course, in the U.S., it was the period largely referred to as the Great Moderation. This was where Alan Greenspan had effectively done what few considered possible, which was to maintain low interest rates while at the same time having low inflation. Certainly low interest rates by the standpoint of his predecessor, Paul Volcker, who had jacked up rates during the 1980s in order to beat back the inflation of the 1970s that had so devastated the Carter administration, caused largely by spending on the Vietnam War, the Great Society of Lyndon Johnson, exiting Bretton Woods, of course, which let that inflation seep out into the economy. It sort of blew the lid on that. As well as the oil embargo and what was going on in the Middle East. But perhaps even more significant than this was the so-called savings glut, as it was referred to by Greenspan and others, which referred to this notion, and it was really a dynamic that was driven by the opening up of China and some of these other Asian economies, the Asian tigers as they were known, which essentially referred to them becoming developed economies or moving towards becoming developed economies. They were exporting more and they were taking the money they were earning from exports to the United States, to the developed world, and they were recycling them into U.S. treasuries. And what that was actually doing was it was driving down interest rates in the United States. It was driving down the yield curve. It was driving down borrowing costs for Americans and consumers, who were then taking that money and recycling it back into the Chinese economy by purchasing those goods. And the Chinese were doing the U.S. a favor by basically exporting deflation to the U.S. They were keeping prices low in the U.S. because U.S. consumers were buying goods that were being manufactured outside. Those Asians were taking that money they were earning on those goods. They were investing it in the local banking system, which was then transferring it to the U.S. through the bond market, suppressing rates and sort of keeping that cycle going, allowing us to have low interest rates and low inflation. And that was the Great Moderation. And of course, that cycle, because it perpetuated itself for such a long period of time, it had a devastating effect on national and private debt levels. And it also, of course, analogously had an effect on the national savings rate, which declined. So debt rose, national savings declined. And of course, debt is always written in nominal terms. And it's your ability to carry it is based on your income, based on your revenue, or based on your gross domestic product if we're looking at it on a national level. And so a debt level, and you can ask Greece, you can look at a lot of countries that are in trouble as a result of this or that have had issues like this, like Argentina. When you have a large debt but that seems sustainable during periods of high economic growth, that debt can quickly become unserviceable during periods of economic contraction. And so along comes 2008, and we get the panic, we get the crisis. We have a massive contraction in GDP, not just in the U.S. but globally. The Fed, the ECB, the BOJ, the PBC, etc. They slash rates, lower reserve requirements, massive bailouts, QE, liquidity facilities, restructuring in Europe through ESM, EFSF, OMT. China, massive fiscal stimulus, public works, etc. Pull all the stops. And for a while, it wasn't clear if that was going to work. I mean, I'll acknowledge I was one of those people who did not believe that the Fed and the central banks, the global central banks, would have the firepower to hold back the forces of deflation. And so 2012, I think, was a really important turning point because that's where I found out that I was wrong. Now, in retrospect, I didn't know I was wrong exactly at 2012, but looking back, that was really the period where I was proven wrong. That was, of course, and that was shortly after, or that was around the time that you wrote the paper Volatility at World's End. And it was not long after that Mario Draghi said, quote, "We will do whatever it takes," that speech, where he basically said, we're going to throw everything at this, bazookas, missiles, nuclear weapons, whatever it takes. We're going to keep deflation at bay. We're not going to allow prices to decline. We're not going to allow for a financial market collapse. And I think that was, and experts see that kind of as the turning point, that speech. But certainly that was the moment, that was the period in time where markets sort of changed, where volatility, I think, began to quell, and we started seeing this new paradigm of complacency that seems to have dominated the market since 2013 in terms of volatility. So I guess, what are you seeing since then? What are you seeing since you wrote that paper in 2012, which was 5 years ago?
Well, 2012 was a really interesting turning point, and I think it informs what's happening now. And I go into this in detail in my latest paper called Volatility and the Allegory, the Prisoner's Dilemma. But in 2012, coming off the great financial crisis and this huge wave of volatility, we saw this tremendous interest in tail risk hedging at that point in time. And as a result, the left tail of the return distribution, the extreme tail events, became very, very overpriced. And I think my paper at that point in time argued that the left tail was dramatically overpriced. That extreme deflationary 50% decline in markets was overpriced. That's what we mean by the left tail. And that the right tail, meaning the rapid increase in markets, was actually underpriced. So that actually turned out to be quite a correct statement at that point in time. But something really unique happened in 2012. And starting really in the summer of 2012, when the market had already recovered, volatility was at five-year lows, central banks began to employ what I call preemptive strikes on risk. So it used to be that central banks responded to economic conditions. You would have jobs turned down, you'd have GDP growth turned down, and they would then apply stimulus. Central banks in 2012 began to preemptively move to strike financial risk by responding to market conditions. This really happened beginning with Mario Draghi's whatever it takes speech, and then also with QE3 at that point in time. So instead of responding to economic conditions, they started responding to market conditions. And this created a kind of moral hazard and reflexive process in markets that I think has resulted in a tremendous kind of, the risk is still there. They thought they're destroying risk, but they've actually just transmuted risk. They've brought asset prices from the future into the present, and they've pushed tail risk from the present into the future while transmuting risk but not destroying it. And we're at a very precarious point right now where that has continued for many years, creating a number of kind of unique situations in the market that I don't believe are healthy.
So, and one of the things so basically around after 2011, the Fed was no longer responding to the crisis of 2008. They were preempting future volatility, future crises.
That's right.
And in fact, you're quoting Mario Draghi, and that was also around the time of Operation Twist on the Curve, I think.
Yeah,
right?
That's right. Yeah. And then QE3 was the big, QE3 was applied. There used to be a dynamic to apply extraordinary stimulus during extraordinary times. Well, they just started applying extraordinary stimulus regularly. And that has resulted in a transmutation of risk. And I don't think it's destroyed risk. It's actually presented new risks that I think will emerge and will become major themes. Some of those risks are financial and some of them are political. And that's a whole other...
Well, let's cover both of those. So financially, the thing that liquidity does in the expansion of the Fed balance sheet is it quells markets. It also, as you say, it embeds in the reaction function of market participants this notion that bad news is good news. This notion that every time we see market volatility, anytime we see an event that should be negatively impactful towards markets. It actually will be positive because we now no longer trade in a free market. We trade in a market that's heavily, to the extent that ever was free, in a heavily manipulated market by central banks. So that has created financial underlying risks. Let's talk about those first, and then let's talk about the political exogenous factors.
Sure.
And then I want to drill down, after we kind of get that overview, I want to drill down into how you guys position yourselves, and then if we can, to what degree we can make sense of that for people that are listening that may not understand the derivatives market and know how to use sort of options. And because I am curious how you guys actually do that. And I'm also curious, just to say this so I don't forget, I am curious what the term structure of volatility looks like past the VIX, further out, and how it is that you guys trade that, because I don't fully understand that at all. So those are a bunch of things. I just threw them out there so I wouldn't forget.
Sure. So let's take a look at this via an analogy, right? Let's say that there's a cancer patient, right? And that cancer patient has, obviously, there is a deep problem and a deep sickness, and those cancer cells and that tumor is growing. Now, that tumor is causing other problems. The patient may not feel very healthy, right? The tumor represents the underlying fundamental problems, and then there are these symptoms of the problems, which reflects the fact that the patient feels ill, doesn't feel good. So imagine you had an irresponsible doctor that just gave a cancer patient amphetamines every single time they came into the emergency room. And the patient gets all these amphetamines and is like, I feel great. It's wonderful. And then they leave. And then they're never actually treating the underlying tumor. They're just treating the symptoms of the tumor. Well, this is what's happened in markets today. So that cancer is a cancer of debt, deflation, and demographics. And it's not an easy one to cure. And the central banks have applied a stimulus of just amphetamines. They just are they're responding to market.
Quintuple the balance sheet practically.
Exactly, right? So they're just instead of actually treating the underlying problem, they're treating the symptom of degrading markets. Now the problem is that markets now have embedded a moral hazard expectation of central bank reaction function. And this has numerous kind of follow-on effects. So the first follow-on effect is this idea that markets are buying the dip at every opportunity. Mean reversion in the S&P 500 is, there's one metric called volatility persistence, which you can back out statistically using something like a Garch model. I won't go into that, but that vol persistence has been at 88-year lows.
And by volatility persistence, you mean that you can make very good predictions about future volatility from historic volatility or today's volatility, that predictions about volatility itself are non-volatile and that it reverts back to the mean very quickly.
Very quickly. Any volatility reverts back very, very quickly. The market has embedded this automatic expectation. So today, every single time there is a sell-off, people are waiting to buy. That's a moral hazard. That's embedded moral hazard. The other follow-on effect is that you end up lowering rates dramatically, and you have a dynamic where companies they're not growing their top-of-the-line sales. In order to meet their earnings per share growth, they're embarking in share buybacks. Mm-hmm. So we have the highest number of share buybacks. We've eclipsed the level since 2007. The entire net operating earnings of the S&P 500 have gone into share buybacks. Let's think about what share buybacks are doing. It's an implicit short volatility strategy. So every single time markets sell off, you have companies buying back their shares. But these share buybacks are a manipulation. It's a financial engineering tool that's being used to, in essence, rob Peter to pay Paul. You're reducing the number of shares, increasing the EPS growth, but you're not doing anything to enact fundamental growth of the business. You know, Steve Jobs once said that when asked about share buybacks, says, well, I don't want to do share buybacks because if we're doing share buybacks, it means Apple has run out of ideas.
Investment ideas, yeah, absolutely.
Well, Apple has now done $87 billion worth of share buybacks, right? I think that says it all. But what we're seeing is an entire leveraged buyout of the entire stock market. This is the only bull market in history Go back, look across the only bull market in history where there's lower and lower volume. And this is because there's less and less shares.
And that, of course, means you are transferring volatility from the present into the future because there's an interested party in the market who won't necessarily be there in the future to support the very prices that he's been juicing if and when they start to collapse.
Well, it's artificially dampening the vol. If you're removing liquidity out of the system, but it's also literally artificially dampening the vol because every single time stock drops, you have a price-insensitive buyer, meaning the company itself buying back its shares.
It's a floor.
So in some aspects, 50% of the earnings growth, this has been some estimates by different banking studies, 50% of the earnings growth the last year and a half has been from 50% of the EPS growth over the last year and a half and 25% before has been entirely driven by the share buybacks, which is not a fundamental economic or healthy corporate dynamic. And these buybacks aren't creating jobs. So companies take debt, they issue debt, and they buy back their shares. They're not creating jobs. They're not creating opportunity. They're not innovating. It's just an accounting gimmick. But this is artificially dampening volatility today. The third factor that drives this is now you actually have a tremendous number of strategies, systematic rebalancing strategies. These are strategies that use volatility as an input. So these are things like risk parity and VAR rebalancing and some systematic CTAs, machine learning. But all of these different strategies have one thing in common, which is they're based on modern portfolio theory, and they're usually based on some sort of rolling period of vol. So they're using volatility as a metric to allocate risk. If volatility is lower, they're able to size more risk. Well, if you have a Federal Reserve and global central banks preemptively issuing strikes on risk, then you have share buybacks driven by the same irresponsible central banking, buying back shares. All of these are suppressing vol. Then these other strategies that use volatility as an input to their risk and their leverage.
And they're adding a whole another layer on top of that.
They're adding a layer on top of it. So we go back to this concept of reflexivity. You end up having this self-reinforcing cycle of lower and lower and lower volatility, and it creates the illusion of the dissipation of financial risk, when in actuality, all that's happening is that the cancer patient is being upped up on amphetamines, and they're not truly getting better. The fundamental problems have not been resolved. So now today, you have the highest debt load in human civilization, the most expansive global central bank balance sheets in human civilization. You have the lowest interest rates in the history of human civilization. We have data going all the way back to 1400, lowest ever, and some of the most expensive equity.
It was financially impossible then to engineer rates this low.
Yeah, we've gone.
The technology has allowed us to get there.
It's allowed us to get there, and on top of that, some of the most expensive equity markets in history, as measured by an enterprise value to EBITDA, and as measured by price to sales and price to book, and case Schiller PE. So this creates a really unique. I'm not saying the whole world will end tomorrow. In fact, what might end up happening is we might have a situation where there's a race to the right tail, where we might have high volatility and high asset returns in a one final blow off top. But either way, there's been an element of vol suppression, and I think this is going to come back with a fury in the next couple of years. And we haven't gotten talking about the populism aspect of this as well.
I do want to talk about that. So the difficult thing with the very frustrating aspect of this has been in making projections over time frame, because first of all, this reflation has, I think, gone on a lot longer than many of us expected possible. And there were a number of turning points, including August of 2015, right before you published Allegory of the Prisoner's Dilemma, where we had the highest spike in volatility since 2011, only to see it revert right back to trend, which just gives further credence to your earlier point about volatility persistence. But regardless of some of those moments, be they August of 2015 or September of 2011 or May of 2012, the forces of inflation from governments and central banks managed to overwhelm markets. And yet, how are they going to unwind their portfolio without the market front-running them? Because right now, all they're doing is raising the Fed funds rate, but they aren't doing anything to address the large amount of liquidity that's just sitting as excess reserves on bank balance sheets, from which, if there were going to be inflation, that's where it would come from.
That's part of I don't claim to be an expert in how they're planning to do that.
You think they know how to do it?
I don't think they know how to do it.
I don't think they know how to do it.
I don't think they know how to do it. Yeah. And I mean, I think if one could...
I think it's all fake it till you make it.
Yeah. And in this situation, you can look at that and say, I mean, to me, my job is to look at the suppression of risk and to look at the potential risk dynamics and to find inexpensive convexity. I feel like they have created a monster and that there's going to be numerous unknown unknowns that come out from looking at trying to unwind this balance sheet. It's very, very, very easy to spike that punch bowl and spike that punch bowl and spike that punch bowl. And now that everyone's drunk, to make sure everyone gets home safely, I think it's going to be very dangerous at this point. And to me, it's about trying to find ways to own opportunity in the event that there are policy failures, as opposed to continuing to find ways to ride the party. I think that's what people need to be looking at right now.
So when you talk about owning convexity, going long volatility, what you're saying is going long change.
Yes.
Because short convexity positions are positions that are all about doubling down on what's been working. If it ain't broke, don't fix it, which is how people have managed to make money the last number of years, where that's been the primary driver, and there's been all this mean reversion in the market.
Mm-hmm.
So how do you guys execute on your strategy, which is active return? You're looking for positive alpha, positive return above the market. And also talk to me about the term structure for volatility, because when we're talking about the VIX, we're only describing 1 month's implied volatility, right? Looking out across the term structure for volatility. In other words, the yield curve, for lack of a better word, for volatility insurance is much longer and stretches out much further than just what the VIX captures. And in fact, if we were going to look at the VIX, that would be like looking at just 3-month treasuries as a gauge for borrowing capacity or solvency of the U.S. Treasury, when in fact the most important bonds are arguably the long-dated securities, like a 10 or 30-year bond.
Well, there's numerous ways to gauge vol, and I mean, I specialize in equity volatility, but this morning I had a great breakfast with someone who specializes in fixed income volatility, and it's very interesting to compare notes in that world. When you look at short versus long vol, and I think you said it right, short vol or short convexity, as I kind of put it, is having exposure to status quo. You're positively exposed to the status quo. When you're long volatility, you're looking to have positive exposure to change. Now, keep in mind, change can occur to the upside or downside. The late 90s, which was a massive bull market, was a period of extreme volatility in equity prices. You had right tail volatility, whereas the 2008 was an example of left tail volatility. So most people think of vol as being just in a market crash, but you can have volatility in rising stock prices as well. The regime that we've been in has been uncharacteristically low volatility and constrained. Most of the world is short volatility. Most traders, and most people don't even realize that they're short volatility. Value investing. Warren Buffett is an example of a short volatility trader. The guy buys into dips, looks to find undervalued stocks. That's a short vol trade. It might be a smart short vol trade. I'm not saying that can't be done correctly, but it's a bet on the status quo.
Because it requires a reversion to the conditions that existed prior to the value opportunity, prior to the price decline. So it's basically a reversion to trend.
On a reversion to the mean, exactly.
Right.
And I think what Buffett has a very long expectation of mean reversion.
Right.
Most people make leveraged bets on short-term mean reversion, and that's where like LTCM, for example, long-term capital management in 1998 went so wrong. They made leveraged bets on relatively short-term mean reversion. Yeah, and then you ended up having a blow-up. I think there's a lot of people and a lot of different strategies that have leverage in short-term volatility strategies, and they might not think of them as being short-term vol. I mean, credit is an example of if you're buying a fixed income instrument at a negative yield or at a 1%, you are implicitly short a massive amount of volatility. You don't think of yourself as being short volatility, but you're getting paid a very small amount of money to take massive risk in the event that the world shifts dramatically.
And a dramatic shift would be a change in interest rate policy. So in that sense, the entire market is short convexity.
Yeah, that's right. So to go back to your original question about different dimensions of vol, so I play in the equity vol space. And, I think particularly in the last year, we've seen a unique regime emerge where there has been exceptionally low vol. Vol has been incredibly low. Spot vol is measured
very low,
very low. As measured by the VIX or measured by realized volatility. But uncertainty has been very, very high. So I use this analogy in one of my papers. I say, imagine this: you have a coworker at the office, and that guy is, he's sitting at his computer calmly, and he doesn't look like he's panicked. He's not moving. He doesn't seem agitated. He just stares at his computer screen. He's very low volatility. But if you went in and you measured his,
I know guys like that,
right? But you go measure the cortisol level of that guy. Right? And you'll see his stress hormones are off the charts. So his stress hormones are off the charts because A, he just got a performance review and he thinks he's going to get fired. And he's thinking about the enormous mortgage he has and he's incredibly over-levered. And his wife is cheating on him and is going to look to leave him. So you don't see all this stuff, but under the surface, he's got a tremendous amount of stress. So he's low vol with tremendous uncertainty. That is like the market today because we have very, very low spot volatility. The market's not doing much, just not a lot of activity. But if you look at the internal stress hormones of the market, and these are things like volatility term structure. We had one of the steepest expectations of forward vol in history the past year on average.
Explain that a little bit. How do you see that? What does it look like? Like, how does that curve look? Like, how do you measure that steepness and how far out are you going?
So you can measure that steepness. I mean, you can actually measure forward volatility going out 10 years.
What do you do that off of?
That's done through a market called variance swaps. But most people are more familiar with the forward term structure in VIX futures, which is predominantly out about 1 year. But when you're buying VIX, for example, you can't buy VIX. VIX is a statistic, so you can't buy it. But you can buy a future on volatility, and that future will trade at some premium or a discount to spot volatility based on the expectations. So even though vol might be relatively low, it might be at 11. Buying the forward expectation of volatility might be at 18. And that can be quite expensive, and most people don't realize this, and that's why there's been a lot of talk about VXX and how in an ETF like that,
which has an element of volatility.
There is an element of volatility built into that estimate. Yeah. And so vol term structure is one way of measuring the stress hormones of the market, just like that guy is. And the guy who's sitting there and you wouldn't see that he's stressed out by his behavior. But if you look under the surface, there's a tremendous amount of stress. And so the last year or so, we've seen very expensive vol term premia. Another one is skew. You can actually look at the pricing of implied volatility at different strike points. And skew has been at some of the most elevated levels in history. Another stress hormone might be something called implied correlation. And then there's the implied vol premium. So if you take all of these uncertainty metrics, they're all very, very expensive. And what this means is that if you're somebody who's just going to buy volatility as a hedge, the problem is that most people say, I want to buy vol. Vol's low. Well, you're not buying vol. You're buying that uncertainty. And as a result, in an environment where vol is low and uncertainty is quite high, the value proposition you get for buying vol is not that effective. And so what ends up happening is that traditional hedging and tail risk hedging becomes very, very expensive. So whereas an active long vol manager like Artemis, we're finding ways to use arbitrage techniques and to buy and carry vol inexpensively. And there's a variety of ways that we do that, ranging from we might sell vol where it's expensive and recycle it to where it's inexpensive within a long vol bias. We may use opportunistic timing, or we may look to find positions where we can own volatility and get paid to do it. But all that requires a tremendous amount of active trading and quantitative evaluation of markets.
So essentially, the way you're going at this is that you're looking to arbitrage volatility. You sell it where it's expensive and you recycle the profits by buying it where it's cheap. And an example of that would be selling the first order movement in order to buy exposure to second or third order movements, which is something I've heard you say before. But I think it's also interesting what you're saying about the uncertainty being high and being chronically high, because it speaks to the fact that central banks' interventions into markets have done nothing to address the underlying problems. In fact, they've made them worse. And investors know that, and they've known that all along. And that's where that constant unease and fear and uncertainty comes from. You know, it's like seagulls or any bird that fishes in waters inhabited by sharks. Those birds still have to eat, regardless of the enormous tail risk posed to them by doing that. And so they're forced along the risk curve, and they know that it could be over at any moment. And that's where that great unease and disturbance comes from, and that tension. And in that sense, they're analogous to the investors and to the fund managers who are still held accountable based on their returns relative to the market in order to justify their fees. And so you have a lot of these guys knowingly going and picking up pennies in front of a bulldozer.
And it's not just the fund managers, but it's the pension fund systems. I mean, people, you have a massive number of...
That's what structural demographics come in, we were talking about.
Exactly. Baby boomers begin drawing down on their retirements this April. So the first wave of baby boomers.
That is a huge thing that no one's really talking about.
No one's talking about it.
No one's talking about that. Why don't you talk about that a little bit?
Well, I mean, if you look at it, there's this natural, the last 30 years, we've had declining rates and higher equity prices. But there's been this massive tailwind with respect to demographics. So baby boomers go into their primary savings years, and they begin stocking a ton of money away into equities, into fixed income. This has created a gigantic savings glut and an excess of financial wealth. Well, that works both ways. And starting this year, the baby boomers begin retiring.
Yeah.
And then all of a sudden, we're going to be coming up against this headwind, which is this wave of boomers that no longer are spending as much money. They're not looking to be risky with their money. And this is going to begin gaining steam in the next 10, 20 years as these boomers begin to retire. So you move out of investments, and they're going to draw down on those retirements and begin consuming the retirement income. And this is pulling money out of the market.
And in fact, this isn't a theoretical thing. I mean, we've already begun to see this. The first country that was on this path was, of course, Japan.
Japan, yeah.
And they're in a devastating situation.
Yeah, 20 years of deflation.
Yeah.
20 years of deflation. And it's, you could put money into the peak. I mean, people talk, oh, stock market always comes back. Well, no, look at Japan.
Exactly.
No, it doesn't. You'd still be waiting to get your money back if you had put your money in the Nikkei at the peak. So I think it's a perfect example of a system of deflation. Now, Japan has other elements that the U.S. is in much better shape demographic-wise than Europe is. I think, in terms of the first world has terrible demographics overall. But if you look at demographics as an immigration-based country, our demographics look a lot better than many other countries. Europe has terrifying demographics. Japan obviously has terrible demographics. You look at Russia, for example. Russia is going to lose half of its military in the next 15 years because they're not replenishing their young soldiers. They don't have enough young men. So their military is literally going to collapse in half on demographics alone. So the U.S. fares better than many of these other countries, but nonetheless, there is going to be a push from putting money into investments to drawing down on those investments.
That also, listening to you talk, it makes me realize that those same conditions are also they also exacerbate geopolitical tensions because, of course, the Japanese are in a vulnerable place right now. They have been for a while as China has been rising, and they've depended on a strong partner with the United States. And the same is true, obviously, of Russia. Yeah. They've felt under threat and threatened, and so I mean to see, that's another huge. To me, it's remarkable that we've had this buildup of risk without some type of steam kind of letting off at some point. It feels like we've really gone on for many years now with this building up. Go ahead.
The risk will be. People say, "Well, what's going to be the catalyst, Chris? What's the long ball explosion? What will be the catalyst?" And the catalyst will be a policy failure. It will be a policy failure or
a mistake, essentially.
Exactly, and that policy failure could be driven by populism. Now, I'm not here to make political judgments on any one person or the other, but I don't think that there is a Donald Trump without a Ben Bernanke and Janet Yellen, and I don't think there is a Le Pen without a Draghi. I do believe that we've seen, as they have sought to financialize and reward and bail out certain institutions, that has rewarded. You have seen a situation where if you've held assets since the Great Recession, if you've held real estate, if you've held stocks, you've done very, very well. If you're the middle class, you haven't seen your real adjusted income increase since the 1970s. And that's an unpalatable situation. It's the worst income deviation in history. So there's been this, they've brought these asset returns from the future to the present, seeking to destroy risk. But what's actually happened is that it's only benefited a small percentage of people. That's leading to political risk. And since 2011, actually you go back to 2012 in my paper, Volatility at World's End, but even before then, at the very end of those papers, I put a graphic from liberally leading the people. Now, it's not because I'm some sort of a socialist, but I put that to say that the real volatility is political volatility. And when economics fails us, we move into a realm of political risk and then war. That's been evident in every fourth turning across history, if you sort of subscribe to Strauss-Howe generational theory. Whenever you have a failure of monetary policy and economics, it leads to political failure. And this is, I think, where you see the greatest risk for a large policy shock. I think global central banks have proven that they're willing to be as irresponsible as possible in order to artificially sustain markets. But what we're beginning to see is a political push against that. And there may not be a EU in 3 years. And that's...
Have you gamed that out in your head, like how you would sort of...
Absolutely.
So how do you see that happening? Like, what is how do you envision that? What are some of the possible ways in which we could get there? And what would that mean in your view? Would it mean a two-tier? Would it mean a complete breakup?
Well, this becomes a dynamic where if you just use sort of Bayesian analytics and run through different Bayesian scenarios, even though the probability of a political movement in France might be, although Le Pen is gaining steam and there's elements there, people didn't give Trump much benefit, but you look at Le Pen, that will lead to a referendum for France to stay. You have Italian elections. Merkel's losing support, right? And then you have refugees.
Very true.
So if you just add these, each one event may not be that probable, but it takes one of those outcomes, the wrong referendum going the wrong way, for Italy to leave, for Europe to leave, or the wrong political party to gain power in any of these places, and you will see an end to the European experiment. That then is a catalyst for global volatility. That is a catalyst. And then if you look at it in our country, right, there is a question as to how, at one end, what are some of the political factors that could drive higher vol here? If we have a more tempered U.S. presidency that drives fiscal stimulus, deregulation, you may have a rush to the right tail, and we might have a repeat of 1998, 99. It's a huge blow up. But if you have a very reckless trade policy with China, and that leads to, I mean, China's debt to GDP is
off the charts.
Off the charts,
Yeah,
right?
and they're hiding a tremendous amount of malinvestment in that country.
Absolutely. So if you have a full-blown trade war with China, right, that could lead into a scenario where China goes into a banking crisis, and they may begin to become militarized with Japan in an attempt to sort of at least unify their country if they can. So you can start to just play out over the next 5 years a couple different scenarios where the status quo as we know it, there's numerous catalysts that are on the surface that make it hard to believe that having a realized volatility of 5 on the S&P is going to be a realistic expectation going forward over the next 5 years.
And all these things are happening also, they're not happening at a market bottom. They're happening at 7 years of reflation.
And keep in mind,
or
it's
8 years of reflation.
It's not just equity markets, right? I mean, equity markets, enterprise value to EBITDA, near all-time highs,
right?
At levels that have prefaced for other depressions, really. Priced earnings don't look bad, but the earnings are manipulated by the share repurchases. So you've got to look at a metric that isn't being manipulated by share repurchases: price to sales, price to book, enterprise to EBITDA.
I should also mention that because many of my listeners I know are going to struggle through this interview, but as far as share buybacks, because it's. The financial press and the press in general confuses the hell out of people, because you'll hear a lot of people say that, well, it's great when companies are buying back their own shares. They'll justify it as saying they're confident, but that's divorced from taking a specific look at it. And like you said, the most significant thing is it means that they don't have a better place to put that money other than to buy back their own shares. Anyway, go ahead. I just wanted to clarify that.
Well, there's nothing wrong with share buybacks, but if you're buying below intrinsic value.
Exactly. So
here's the question. These companies are buying back their shares at historic levels while there's also simultaneous insider selling.
Mm-hmm.
If you're buying back your shares supposedly below intrinsic value because you think there's value, then why are you then
it's just more reshuffling.
Yeah, it's just a financial reshuffling.
More redistribution.
This comes down to I'm a corporate exec. I need to hit my EPS target, and I can't do it by growing my business. Let's go buy,
because those targets are connected directly to their bonuses.
Their bonuses. So let's go ahead and issue debt and buy back our shares. And there's nothing illegal about it. That's the way that they rules
should be.
I think they should look at it and say
it should not be happening.
Yeah, but it's the reality. But at the end of the day, it's an accounting mechanism. But what's even scarier than the stock market is the bond market. I mean, this is incredible.
Scary.
When you look at the
it's freaking terrifying,
it's terrifying,
man.
It's absolutely
Funny?
terrifying.
I'm here struggling with this interview because I'm like, how do I talk? I'm looking at your stuff before we do this interview. I have been out of this whole area. I've really just taken a step away. In fact, my very first interview on this show was on tech, all on technology.
Yeah.
We cover a lot of different things. But I'm looking to kind of, get my head around what's going on in financial markets again. And I've been looking at it because I had an interview right before you with Jim Rickards. And
wow, he's fantastic.
Oh, he's great. Yeah, it's the interview's done really well. This podcast hit top charts on iTunes on the second week.
Wow.
I know it's done really well. So, but we'll see. I'm actually trying to figure out how do I really want to work these discussions because the audience is pretty broad.
Well, Rickards has hit on this concept about how they're going to freeze the system.
Freeze the system, yeah.
Because this is okay. You go back, everyone sits back. It's, the mortgage crisis. That was so obvious, right?
Yeah, exactly.
Of course, it's always obvious after that. What's going to be obvious in maybe 10 or 20 years? Exactly. This idea that right now, the entire financial world is built on this idea that you invest in stocks and bonds and they're anti-correlated with one another, right? So this idea that I hold a set of treasury bonds or other sovereign debt or other liquid corporate bonds, and that's an offset. When my stock portfolio does badly, those bonds do really well, and vice versa. So if I go down to an average financial advisor here in New York or where I'm from in Austin, Texas, and I say, well, chart me a retirement plan. It'll put you 60-40 stock bond split. And then if you have a lot of money and you go down to Connecticut to certain $100 billion funds, they'll tell you, well, we're going to lever the bonds and against the stocks, right? Okay, great. And that's what risk parity is. And that is based on this evidence over the last 30 years, right? In the last 30 years, it's worked brilliantly. It's worked great. It's worked great. But it's worked great as interest rates have dropped and dropped and dropped and dropped. And we're now at the zero bound. So for this to work really well, stocks and bonds, bond yields have to go to like -3%, -5% for this relationship to hold. I will say this much. What's amazing, if you look at the history of this stock-bond correlation relationship, the anti-correlation has predominantly occurred in the last 30 years. So if we look at the last 120 years, stocks and bonds have spent more time correlated with one another than anti-correlated with one another. It's only in the last 30 years, my lifetime, that stocks and bonds have been anti-correlated. So now that we're at the zero bound, if you're making a bet on this anti-correlation relationship, then you're implicitly saying that to get the same benefits you got in 2008, yields have to go to -3%, -4%, -5%. Has that ever happened? No. Could it happen? Maybe. But I will say something that has happened. I can absolutely show evidence of this happening, where stocks and bonds decline together for a period of 2 to 3 to 4 years.
Panic of 1907, I think, was one of those.
That's right. The period of that's right. In the early, exactly right. 1907, 1912. We saw it happen in the 70s to a certain degree. So what happens to these underfunded pensions?
Like Carter, 78, 79, I think, and also right after the recession of 68.
Yep, there was
LBJ transition Nixon.
There was a period, but during these periods of time, it was a much less leveraged system, and we had the baby boomers coming into the dynamic, and rates were arguably very high. In this dynamic, you could see a scenario where stocks and bonds for 3 years, 4 years decline in tandem. That would be the ultimate bear market. And even if they declined for 1 year together, everyone freaked out when they went down simultaneously in 1 month during the taper tantrum. But if we had 2 years of underperformance, the type of chaos that could inflict, and the number of people who have some sort of hidden leveraged position to that relationship, it will be the ultimate kind of breakdown. And so we have this entire financial engineering. The entire system has been engineered
to function in that manner.
To function in this manner.
The dynamic that you're describing that has not held in history the majority of times.
And we take it for granted. But if you look historically, if that relationship doesn't hold, what is it going to mean right at a point in time where everyone is retiring and everyone is following the same strategies that are applying these ideas?
That's the fun. So you're touching on something, which is that it's a critical event for the system itself to have a deviation from that correlation.
Yeah.
And yet that's what you're implying. And I'm surprised. Again, I've been surprised that we've managed to go this long with it. In that event. And again, that's the other problem, and I think that's why gold has been a very effective long-term play, because it's been a hedge against systemic risk, and I think just a loss in confidence overall in the system itself. Where does money go in that scenario? Let's say money leaves the bond market, it leaves the equity markets. Demand goes somewhere else. If it's leaving from there, it's going for. Where do you see that? I mean, how does that express itself in terms of rising prices elsewhere, real prices elsewhere, if not nominal real?
Yeah, it's an interesting dynamic, because I think that I do agree with the thesis that they will seek ways to freeze the system, to stop sort of an outflow, because if you have a loss of faith in the system, people will seek alternatives. Right now, people are looking to get money out of China, so we're seeing. It's fascinating to see the rise in the price of Bitcoin. It parallels the rise of China interbank lending. You look at Bitcoin's price and you look at China interbank lending, And then I go to places. I just came back from Sydney, so I'm in Sydney.
As the interbank lending rate in China rises, the price of Bitcoin rises. Is what you're saying?
Yeah, that's right. What you're seeing is actually you're seeing loss of trust and people looking to get the money out of the Chinese system. And it's exactly why you go to Sydney and you go up in front of one of those restaurants that's the sort of cheesy rotating restaurants with a view, and you look around at all the apartment buildings, and so many of them there's no lights because they're Chinese investors have just bought.
Forget about it.
Yeah, they've bought all these properties in Australia, and they're not even renting them out.
Yeah,
they're just land banking them. It's a form of capital flight from.
It also reflects a real breakdown in the resource investment allocation dynamics of the global capitalist system as a result of these policies. I mean, the inequality is a reflection of that. I mean, if you're investing in building apartments and where the demand is coming from people that don't even want to live in them, there's something grossly wrong with the system.
Yeah. I mean, that's what you're seeing in places like Vancouver, in Sydney, in Auckland, New Zealand. Actually, even in as far as Austin, Texas, you see this effect. I mean, it's absurd to think that you have, but there's money flowing out, and people are looking to allocate it and get it out of a system. So the idea of freezing the system is a fascinating point, because I think that could be the next kind of, the bail-ins might be the next step.
Well, that's kind of the tension, to sort of play off that parallel of the tension between inflation and deflation. There's a tension between authoritarian elements, central distribution, central control, versus distributed system, freer, sort of more chaotic, anarchic elements. And I think what you're talking about with the freezing is exactly that, which is the established institutions, corporations, et cetera, are looking to try and preserve the status quo with whatever means possible. And if they have to freeze the system, and for you, freezing the system means a global bail-in engineered at the level of an IMF or something like that is what you're describing. Pretty much what Jim talks about.
Exactly, across coordination to avoid sort of massive selling. So, I mean, in some ways, you sort of saw a hint of that in China. Mm-hmm. It's fascinating to think that, we talk about preemptive strikes against financial risks. China spends an estimated 20% of their GDP, supporting their stock market before a military parade. I mean, that's just a perfect example. Or people forget about this. James Bullard going on TV and going on Bloomberg, the market drops 5%. 5%. In October 2014, he's on television saying, "Oh, let's do QE4. We'll think about QE4." Right? Just saying that. I mean,
it's so insane.
It's insane. I mean, it's unfathomable. I mean, why are people not calling out the credibility here? I mean, it's just And then 6 months later, he's talking about rate increases. I mean, it's hilarious. I think in terms of where vol as an asset class stands in this. You can't go hide under a rock in cash, because if you do that, you could see a scenario. There's different policy actions where, if they deregulate the system, do massive fiscal stimulus, there's not a reckless type of trade war. You end up having and cut corporate taxes. You have all this money come back onshore that goes back into share buybacks. We could be in a 1998-99 style environment again. I think we might go right tail and then go left tail.
Does the right tail express itself in equities and in what else? I mean, where do you see that inflation happening if it happens on the right tail? When you're talking about right tail, you're talking about an inflationary scenario. Prices rise, and the volatility comes from rapidly rising prices.
Or a reflexive dynamic where share prices rise, people begin chasing it because they have to. Everyone's being evaluated on it. Every manager out there is being evaluated on a 3-year track record, or people. In some instances, you have situations where, like these superannuation funds in Australia, if they spend any money on a hedge, they drop 10 ranking points, and then they're being evaluated on some 2-year record. So you end up having like a late 90s scenario where people are chasing performance, and that creates its own kind of false sense of demand, of course, until the Wile E. Coyote moment occurs. But so I think it's difficult to just if you're in a situation where you're entirely distrustful, you can't just go purely into cash, and you can't purely pull out of the system, because there could be a scenario where we end up in that kind of hyper something becomes overvalued and goes hyper overvalued. That's entirely feasible. At the same time, where do you hide when stocks are overvalued and bonds are overvalued? Where do you hide? I'm a believer in owning gold. I think it's one part of the solution. And I think people need to look for alternative asset classes that allow them to be allocated to equities and risk that actually show anti-correlation. So one of those asset classes is volatility. So long vol funds like Artemis, we're a member of the CBOE Long Vol Index. A 50-50 combination of the CBOE Long Volatility, CBOE Eureka Long Volatility Hedge Fund Index. So it's 10 like-minded hedge funds to Artemis and the S&P. That 50-50 combination since 2005 has outperformed the average hedge fund by 90% with twice the risk-adjusted performance of the S&P. So using long volatility as an asset class, it hasn't done well over the last 3 years, right? 4 years. But long vol, unlike tail risk, is more opportunistic. The average tail risk fund might be down, I think, almost 50%. To make back that 50%, you have to make 100%.
What's the distinction there between the tail risk funds and the long volatility funds?
Tail risk is a pure form of insurance. You buy the uncertainty, you hold it, and it bleeds. You lose money, but you're guaranteed a payout under all conditions. Long volatility may use opportunistic arbitrage opportunities and different timing. You have more basis risk, so you may not make money on the first 5 or 3% down, but you're looking to make a lot of high returns when market's dropping 20% or 30%, or when it's going up 30% with high vol.
Wouldn't that qualify as the tail risk, or that's not a tail risk?
Well, the difference between long vol is you're finding ways to carry that exposure to change without the negative bleed. So the average tail risk fund might be down 50% since 2012. The average long vol fund is down about 7%. So it's a much more palatable carry profile. So long volatility provides one solution because in a situation where there's rapid change and high vol, long vol can do very, very well, but it's not losing money the way tail risk does or the way that some of these other products are. Other opportunities exist through funds that are like systematic CTAs. CTAs provide exposure to market trends and can perform. And then some contrarian global macro investors, guys who bet on change and optionality through macroeconomic change events, can provide some element of protection. I think one has to get very crafty about finding. You have to imagine how can I craft a portfolio that does really well in the event that stocks, bonds decline at once. You can't be 100% in gold. That's not feasible.
Right.
So the idea is to find a collection of other diversified investments that are anti-correlated and are positively exposed to change, but that are not losing money dramatically every single year the way tail risk does.
So how does let me ask you this: how does someone who is not invested in directly in a fund that actually actively manages that, like Artemis, how does someone? I'm sure you get asked this question all the time. How does someone who is not who doesn't have that type of money? How does that person invest in financial markets in that manner? It's
actually one of the biggest issues because these products are oftentimes institutional products. They're not really geared towards the retail market, so that becomes very, very. There's not an easy solution to that question. There are some liquid alts funds. You have to be very careful about what you're buying, but there are some liquid alts and CTA-based funds that are kind of based in liquid alt strategies. But you have to be very, very careful.
You're referring to liquid alternative funds that look to replicate some hedge fund strategies.
Yeah, exactly. And you have to be very, very careful what you're buying and to make sure that those. I can't give financial advice on that.
Right.
But yeah, for someone to do the research and to actually understand what those products are and what the fee structures are in those. But I think it's an incredibly difficult question because if you're a $10 billion institution, you have access to a lot of these different ideas. It's very difficult for the guy who has $100,000 personal retirement system to gain access to smart convexity outside of these very large based stock and bond index funds.
So, but philosophically speaking, what you're essentially saying though is that you want to be positioned to to take advantage of change.
You want to be
could do
positioned that way.
You could do that in your personal life in different ways. I mean, you could do that. I'll tell you one of the other things that I don't know if have you read anything about the electric grid? You know anything about the electric grid and the vulnerability of the grid?
Oh, that's a fascinating point, right? I mean, I don't know. I don't know exactly, but you talk about unknown unknowns. It's a great example.
You go long convexity just by buying a satellite phone or a walkie-talkie or some freeze-dried food.
Yeah, that's right. That's 100% right. When the concept of convexity is really powerful because gold is a form of convexity against the failure of policy. But it's true when Texas has homestead laws. So you're by buying real estate in Texas, you have a legal protection. Any event, it's very difficult for for someone to seize a home. That's a form of convexity that allows for protection and exposure to nonlinear exposure to inflation and other aspects in a legally protected form. So. Freeze-dried, freeze-dried fruit is another perfect example of that. Or even just having a car that won't be, or having a motorcycle that won't be fried in the event of a solar flare. You can carry it as far as you want to go. But
yeah, and I think what you're touching on is that we've scaled our society, our global village, in such a manner that it's become very fragile. It's very complex, and it reaches moments of criticality. And we have layer upon layer: infrastructure, information systems, satellite communications, supply chains, hospitals, medicines, antibiotics, the prison system, energy consumption. I mean, all these things are built on the presupposition that we will be able to maintain them indefinitely, and the types of events that we're describing here that would move volatility in financial markets, some of these could potentially cause catastrophic effects to some of these assumptions.
Yeah, and many other elements. And I think it's hidden. The fragility is quite hidden. I think we're going to see this because the fragility, the lack of volatility is self-reinforcing. So today in markets, you have all these, we talked about some of these factors that come into play where central bank reaction function, you have share buybacks, you have strategies that use volatility as an input. These are all self-reflexive, so it's very difficult for vol to break out of a certain point. Vol rises, and these pressures, these reflexive pressures, begin to push it back down. But if you get the wrong policy shock that pushes vol past that initial point, all of these reflexive factors that are reinforcing lower and lower vol work in the opposite direction. So there's this theoretical air pocket where once a shock is large enough for a significant shift beyond the reflexive barriers, the shock factor can go up by a magnitude that is much higher than people fathom in a nonlinear fashion.
A positive feedback loop.
It's a positive feedback loop. So the positive feedback loop works to reinforce lower vol now, but with the wrong policy shock, the same things that are reinforcing lower vol will turn to reinforce higher vol. And that's where we end up with like a 1987 style move in markets. That's an interesting factor because if you looked at what happened in 87, you had this large, people always blame it on portfolio insurance. Well, that was in the middle of a bull market. You had inflation jump up dramatically earlier that year. And nominal rates shot up even faster than inflation did. And what ended up occurring is that caused a liquidity seize up in the system. And that liquidity seize up suddenly exposed all of these short vol, short convexity type strategies like portfolio insurance that led to a reversal and a very large shock in markets.
And that was also the beginning of electronic trading.
Yeah, that's right.
Some of that was driven by machines.
But this could be a very interesting dynamic because everyone wants to manufacture inflation. Well, be careful what you ask for because if we end up getting an inflation shock, that could be the very thing that causes the liquidity seize up in the system. I don't think money people are prepared for that.
Explain that a little bit. How would that happen?
Well, it would happen in a very similar fashion to 87. I mean, we actually, that's the template. People blame it on portfolio insurance because they don't want to look into the, portfolio insurance had an impact, but I think it had an impact on the later parts. The market sold off 11% prior to the day it dropped 20%. And what ended up happening is that you had increasing inflation in a bull market and a large jump in nominal rates. That led to seize-ups in interbank lending, which were occurring well before that happened a month and a half prior to Black Monday. So you have this sell-off that's, it starts as a negative 2% sell-off, negative 5%, it goes to negative 11%. You have a seize-up in lending, a seize-up in liquidity, and then you throw on some of these self-reflexive strategies, and all of a sudden that air pocket in volatility exists where it's a very slow rise to 30 and a very, very quick rise from 30 all the way up to where vol went on to nonlinearity up to 150. And it looks like it comes out of the blue. In retrospect, it feels like it just happened. But if you look at the evidence, there's this buildup. You could see that the whole world is levered to low rates and low volatility. And then you could see a situation where if we actually get a ramp up in inflation too quickly, that leads to some kind of liquidity seizure, which leads to a rapid unwind of those shortfall positions, we're back to that 87. And that is an interesting kind of template for something that could occur.
And that's what leads to those air pockets you're referring to, because those are not realized until each entity, investor, or mutual fund or whatever gets feedback from the market that tells it, hey, your protocol says it's time to sell. And when a critical number of people are functioning off that same protocol or template, you can get a very large move down in a very short period of time. And it can wreak havoc with models if there aren't any market participants there able to adjust on the fly to information that doesn't fit into some predetermined model, essentially acting as brakes to market collapses.
That's right. Yeah. Look, this is the way things always blow up in life. If you cannot destroy risk. You can't destroy risk. You can transmute it. So if you go over, and the analogy has always been about forest fires, where, the idea that you try to, you put out forest fires over and over and over again, you're actually creating more dry foliage. You're creating the potential for a larger fire. Marriage counselors will say that the couples that are most likely to divorce are the ones that aren't fighting. They're passive aggressive. They're putting out they're refusing to bring anything to the surface.
They're not pricing their problems.
Yeah, that's right.
The lack of transparency around pricing has been, I think, the central biggest problem that we've faced. And of course, when you don't price the risk-free rate, you're affecting the price of everything else. Anyway, go ahead.
Yeah, no. So marriage counselors, the avalanche detection, they go out, they go skiing up in Jackson Hole. They're out there early in the morning, making little controlled explosions to release the pressure in the mountains. Well, and cancer's the same way. If you give the patient, amphetamines instead of treating the tumor, the patient's going to die. Well, we've known this in fighting forest fires. We've known it in fighting avalanches. Marriage counselors know it. We know it in medicine. Apparently, though, we've just lost our way in global finance, and I think part of the reason is because there is a reflation of a certain. There's an Uber class that's benefited from that, and a financialized class that's benefited from that. But we have created new risks that are very even difficult to fathom, that are even beyond my ability to sit down with Bayesian analytics and come to a realization on what they are. You can sit back and clearly see what events may lead to a EU breakup. It's hard to actually see what air pockets exist from that are not seen, that have been paved over. And this is where it becomes really interesting.
Are you seeing that reflected at all in any of because the zeitgeist, through film, I don't know if you've seen Black Mirror. Have you seen Black Mirror on Netflix?
I've seen one episode. Yeah, it was fantastic. So, yeah.
Although that's a commentary on technology, and I think, that they do a really excellent job of conveying that unease in the society around that. because in your papers you mentioned Mad Max, Road Warrior, and there's another film also for long convexity analogy. But like, do you see films reflecting the anxiety? And are there any films that you've seen in the last 5, 6, 7, 8 years that reflect the anxiety of the population around this fact that we understand that we're on an unsustainable path? We just don't understand how it's going to play out or where it's going to play out.
Absolutely. It shows up in pop culture all the time. I think, and actually one of my favorite books, and I think it should be a book that every risk manager reads, is World War Z. Skip the movie. The movie was ridiculous.
That was Brad Pitt, right?
Yeah, it was terrible. The movie had nothing to do with the book. They just stole the name. But the Brooks's book is fantastic because it's all about global policy in action to you have a nonlinear problem, a nonlinear extremist problem, and how different organizations, both on a macro and a micro level, either respond or fail to respond. And the rise and the popularity of the zombie film, I see, which coincided directly with the financial crisis, I think monster movies always reflect this underlying tension. Zombies are a non-linear problem. You have it's like a financial crisis or an ecological crisis. It's non-linear, where you end up having what starts as a linear issue gradually becomes exponential in nature before it becomes out of control. I think the rise of the zombie genre reflects the underlying tension with how policymakers are failing to respond to a non-linear problem. And that really gained steam after the financial crisis. You saw, things like The Walking Dead and all these other...
The winter is coming. I don't know if you've seen Game of Thrones, but I think that's exactly right. I mean, the outcome of defeating your enemy, which is dead people, are then harvested in the long game to come back at you in the form of winter, which is the armies of the dead.
Exactly. Yeah, that's that theme. and now it's like we just have zombie companies and zombie institutions that are, but it's that, how do we respond to extremism and how do we face that? And today we're seeing that threat not only financially but technologically. It's when you look at today, I think it's, can't remember the exact stat, 4 to 6% of the jobs are cashiers. And, Amazon is experimenting with stores where you just...
Automation is going to be, absolutely.
We have automations that people talk, well, we want to bring jobs back to America. We have twice the manufacturing we did in the 80s with 1/3 the amount of workers. That stat's staggering to think about. And we're not even starting about the idea that the number of jobs that are driven about driving. And I came here in an Uber.
6%, I think, is the estimate for job losses by 2021.
Self-driving cars. And I look at some of I think my first job in the financial industry could be entirely done by a machine now. I really think about it. Well, it's staggering to think, and it creates this is a nonlinearity that's gaining steam, and there is that kind of tension. It goes beyond just finance, but there's that tension, and you're seeing that being reflected in the monsters of our pop culture today. And I think that's going to manifest. Not only it's manifesting through pop culture, and it's manifesting through populism.
Let me ask you one more thing. And this is obviously, you're not a prognosticator. You can't, and your whole position, your whole job is to be able to position yourself to benefit from change whenever it comes. But do you have a personal feeling? Would you be surprised if 3 years from now we're still here in this place that we're in today? And when I say place, I mean where we have not had a significant change in volatility.
I would be shocked. I would be truly shocked. Yeah, that would be...
So within this first administration, within the Trump administration...
That would be shocking to me. Although I have been wrong for 2 years. In fairness, I've been wrong for 2 years. I really felt like things would begin to get out of control in 2015, and we saw that...
When you wrote The Prisoner's Dilemma, when we saw the mean reversion in August after that.
Yeah. But to clarify it, I think that could break out in either tail, because I could see a scenario where the late 90s, for example, was a period of extreme volatility and high asset prices. The VIX averaged over 25. You had multiple vol spikes to 40. You had 2 periods of peak to trough drawdowns of 20%. So you had a tremendous amount of volatility with very high stock prices, depending on how the policy levers are pulled. And it's very confusing. Well, I'm not smart enough to predict how those policy levels would be pulled, but
what they would do.
But I could see either scenario where we would have a break to the right tail with extreme asset prices or a break to the left tail. I would be shocked if we came back 3 years from now and vol was averaging 10, the way it's been sort of doing in this sense.
Then you're going to be even more scared shitless.
Yeah, then I think you can, like I say, I think you can push off the risk.
Yeah.
But I think eventually that volatility has to, and sometimes people will sit back and say, well, Chris, what about the 19, vol was very, very low in the early 1960s, for a later part of the 50s to the early 60s. Yeah, we just won a world war, and you had this tremendous job creation, tremendous manufacturing, tremendous growth.
Demographics.
The middle class. Yeah, that made sense. All of those factors are moving in reverse right now. So the people, I think there's one bank that released a paper that's, we're just going into the low vol regime of the late 50s, 60s. I disagree. I think it's a little bit, the factors.
Who released that? I didn't see that.
It was a well-known bank.
I got to look that up after this.
I respectfully disagree with that assertion.
That's interesting.
So,
and what were they basing that off of? The idea that that the central banks would be able to maintain low volatility?
I think you have.
What are they thinking? I mean, they don't think it's a natural condition of the market.
This is one of the problems with. We've done a lot of experiment. Like, we use machine learning in our techniques. We use a lot of quantitative and systematized metrics. But one of the problems with pure quants is that a pure quant will look at the last 10 years and they will optimize. They fall in love with the data and they will optimize and curve fit to the last 10 years, the last 20 years. And I think sometimes you have these reports where guys are pure quants and they just look at data without really thinking about the underlying conditions that drive that data or why that data, interest rates have dropped. Had one of the largest declines in rates in history. So maybe the last 20 years that our systems have been optimized to that, maybe that's not the best assumption to assume for the next 20 or 30 years. But the pure quant approach looks at those data assumptions and carries them forward and optimizes around them. And what's a little scary is that you have a very unique period of time where baby boomers have been at their prime in terms of spending. There's demographics. The U.S. has been a unique moment of financialization with lower and lower interest rates. And we have created an entire technological and financial system that is optimized to that data set.
That's a really great point. I've talked about that before on this show. In fact, the very first episode I talked about that, which is we have a love affair with data and we have a love affair with measuring things. I use ESPN as a classic example, which is if you don't have a way to measure it, you kind of don't look at it. Or if you don't have a way to measure it in a way that's proper or makes you feel good, which makes you leave out a lot of stuff.
Yeah. Machine learning, it works great in a closed system. So, machine learning, you use it for spam detection, for example. Right? Well, that's a pretty simple problem. It's a closed system. Even something that seems complex, like a self-driving car. Roads, in many ways, you can model out the number of situations that might occur on a road. And they're already having trouble with some of the more difficult ethical considerations. But facial detection, even something as complex as a car, there's a gazillion scenarios. But if you run enough cars, you can model all those scenarios, or 99.9% of them. The problem with politics and financial markets is that it's a changing organism with incomplete data. So the data that was relevant over the last 20 years is changing, and the scenarios that we're likely to face, or the very impact of technology itself on those markets, and the impact of technology on some of the economic indicators that we use to make decisions, these are changing. So you can't use a frequentist type statistical approach. You have to use a more Bayesian type approach.
Yeah.
It's very hard for machine learning to do that. As advanced as machine learning is, it's very hard for machine learning to do that. It's still a great tool. I'm not
That's a very, very good point.
But this is part of the problem. Imagine trying to create a self-driving car where as those cars are driving, the rules and the composition of the road is shifting. And that's the problem with applying these techniques in a pure fashion.
And there is no constraint as to how those rules can change and how the road can change.
Exactly. And then all of a sudden it becomes much harder for that car to navigate because you're always looking in the rearview mirror to the last kind of dynamics that occurred. And if the road is shifting shape and the rules of how how you drive are changing, the car is not going to be adapting fast enough to that.
You need creative thinking, which is why a lot of people think that active managers will be you'll want to be in a position where you're actively managing or having someone actively managing your money during a period like that, because of the fact that having an algorithm do it, and I don't mean a computer algorithm, I just mean any kind of pre-programmed approach protocol is going to be inadequate to deal with the type of creativity required at that moment.
And if we want to talk about one of the major things this is fascinating. There's such a push towards this active versus passive as its own discussion. Right now everyone says no one wants to be in active management at all anymore, right? Everyone says we want to be passive. There's like someone suing a pension system because of they were not in passive, they're in active managers.
For all the fees.
Yeah, right, all the fees. Well, let's go back and look. Passive investments, the S&P during this period of central banking has had one of the highest Sharpe ratios in 200 years of equity data. So you're top ticking the highest risk to return, some of the best performance of beta in 200 years worth of data. By beta, I just mean the standard index funds. On top of that, many active managers are being driven out of business. What do active managers do? If stocks get too high, they sell. They're looking for intrinsic value, so they'll sell overpriced stocks. If stocks get too low, they buy. They act as volatility dampeners. If you have a nice balance of active versus passive, passive investments or index funds are this like communism of finance. It's just everyone gets a certain amount of capital based on, and then
there's no resilience in that type of a system.
Yeah, there's no resilience. So if you have active managers become very healthy because they're trying to find intrinsic value, and in essence, they remove volatility of the system by acting as a dampener, buying when stocks drop and selling when stocks go high. If you remove, in a world where there's no active managers, the potential for volatility is amplified.
Because everyone's leaning in the same direction.
Everyone leans.
Increasingly.
So every incremental buyer drives stocks up dramatically higher if there's no one to look for value actively. And then the same thing, every incremental seller, you turn around to sell and there's no bid and markets drop. So if the whole market moves to passive, you actually have a nonlinear expansion of the potential for volatility. So this whole push towards passive, this whole massive push towards passive investing, they have the new DOJ rules coming onto effect now, and managers are being taken out left and right. Say, we don't want to pay fees. We don't want active management's dead.
Talk about that DOJ rule a little bit, because I think that's a good example of unintended consequences.
If you're an investment advisor, it makes you have a fiduciary obligation in order to put your clients in the lowest fee structure.
Right, okay, fiduciary.
Yeah.
That's the key.
And then even beyond that, you're held personally liable. So let's just say you put your client in a active manager that charges a 1% fee versus a passive fund that has a very low fee. That active manager underperforms the index fund. All of a sudden, you're liable for that lack of performance. Now that sounds like, oh, great, we're protecting the little investor. But the implications of this are massive, because consider that active manager might be holding some element of cash, because they might be allocating to certain stocks that are not popular at that point in time but represent good long-term value. or they might be holding cash in anticipation of being able to buy when overpriced stocks drop. So these are factors that you would consider prudent looking out 10 years, but it might cause them to underperform for 1 year or 2 years. As a result, then, that investment advisor is liable for that underperformance. So they have to go to index funds. You put all those active guys out of business who are, we go back to the share repurchase programs. Well, guess what? What stocks have outperformed have been the ones that have the largest share buyback programs. They may not be the best stocks. That might be irresponsible management.
And they're not, and there may not be those buyers available to prop those stocks up in the event that there's a price vacuum.
Yeah. So the prudent manager says, I don't want to invest in a company that has no intrinsic growth, right, and is just buying back its shares to give their CEOs bonuses. That manager is being penalized for making that choice, and then in essence the index funds are rewarding those share repurchase programs. So you have this, it sounds like a great idea. Oh, we're protecting, the little investor. But this actually results in these perversions in markets that down the line can actually cause a large amplification of volatility and unintended consequences. And this is happening right at a point when there's a tremendous amount of likely selling pressure from retirees looking to convert their retirement funds into consumption. So it's going to be a very interesting framework. I think this is a classic example of unintended consequences of some regulation.
Chris, it was awesome having you on, man. I gotta say, it was intense.
I hope. Yeah, I hope it was worthwhile. It was really fun to be a part of this.
Yeah, it was awesome, man. It was awesome. Thank you so much for coming on. It's great seeing you. All right, thank you.
Been a pleasure.
That was my conversation with Christopher Cole. I want to thank Chris for being on the program. Today's episode was produced by me and edited by Connor Lynch. Sound engineering was Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforcespod.com. Join the conversation on Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforcespod.com. Thanks for listening. We'll see you next week.